Today is going to be day 8 of covering 10 companies in 10 days. What's up with this? Welcome. Today is day 8 of covering 10 companies in 10 days. Let me just test out the stream to make sure everything is working. Welcome. Today is going to be day 8 of covering 10 companies in 10 days. And today we'll be talking about Affirm. I think while we're waiting for people to stream in, I'm just going to take a look at the markets today. I hope everything is working fine. Give me a minute. Let me just check. I still don't understand why is it sometimes people can't comment when I start. So I just need to double check this. All right, I hope you guys hear me fine. Like I said, today is going to be the 8th day of covering 10 companies in 10 days. But before we begin, I just want to take a look at the markets today. NVIDIA's results was actually, was actually good. And I think, you know, I'm surprised that I think because of the fears over some of the news coming out about China and things like that, that's why people were a little bit afraid of NVIDIA. But you can see generally the portfolio is up, markets are flat. I think it just so happens that, you know, some of the companies that I hold over here are up. If we look at the portfolio, I mean, we ended yesterday at 608, so you know it's just a $5,000 jump today. You can see we added 12 cash secured puts on BMNR at around 97 cents, I believe. So those are profitable right now. It's 97, yeah, 97, so 87 cents. And then at the same time, we also have Lululemon. Now, these two, for me, I already have a position. I already have my own position in Ethereum. So I already have my own position in Ethereum. So I'm not like in a hurry to definitely get on board this BMNR train. Of course, if I do get assigned shares, that's fine. The reason why, I think let me just explain why I chose $40 for the BMNR cash secured puts. So these expire next Friday, 5th of September. Imagine 97 cents, which is $97 per contract. And then I have 12 contracts. So that's basically $1,164 in just 1 week. Of course, could BMNR, I mean, BMNR is a very, very volatile stock. And so definitely, I wouldn't be surprised to actually get assigned the shares at $40. Now, the only thing over here is that I think net asset value of BMNR is around the mid $30 range. The last I checked, it's around $36 or $37. Right now, receiving 97 cents to buy BMNR at $40, which that would actually put my average cost basis closer to around $39. And that means I'm actually paying less than a 10% premium. Now, I think if you have heard Tom Lee's explanation on why BMNR makes sense on Amit's channel, when he gave that interview, I think you would understand that paying less than a 10% premium to get into a company that essentially helps you grow your ETH holding faster than how fast ETH can grow. That basically is one of the bull case for this, especially if you believe that the entirety of Wall Street will eventually get into will eventually be basically brought onto the blockchain, right? Now, I think the thing we have to understand over here, and I think Tom mentioned it, which podcast was I believe it was the Bankless podcast. They actually asked him how is he managing to buy so much Ethereum without the price of Ethereum going up. He didn't explicitly explain how he did it. I think because that would be exposing too much. But he did say that they have their ways of making purchases of Ethereum without it affecting the price of Ethereum too much. So I don't think people should buy Ethereum or buy into BMNR thinking that this is going to definitely pop very, very soon, and then it's going to go back to the $100 range where we saw it previously. Could it? Definitely. If Ethereum gets to his target of 5,000 to 6,000 by the end of the year, definitely. But I think beyond that, the reason why I like BMNR is that the Ethereum that I hold in my crypto wallet, I can stake it, and that's about it, right? Whereas in BMNR, I only get exposure to Ethereum. I get to run the real strategy on it, so it actually generates me income as well, which makes this a much more sustainable position for me. Okay, and so because of that, that's how I ended up selling these. So you can see I'm positioned fairly well going into mid-September. The reason why mid-September is because I'm going to be traveling from that point onwards, and I don't want to be thinking too much about a portfolio by then, right? So right now we have Lululemon, 2 cash account puts worth about $1,700, expiring 19th of September. BMNR worth about $1,100, expiring next Friday. So I will probably renew this for another 2 weeks until 19th of September as well. I have a 19th of September SOFI at $23, just 10 contracts over here. This basically is to cover the 10 SOFI shares that I sold at $26.05, where I realized some profits. And then I have another 10 puts at on 19th of September as well. And so the idea over here is for him, it's for me to grow this into maybe a 2,500 share kind of position. Right now, if this gets assigned, I'm at 2,300. So I still need 200 shares more. If this doesn't assign, basically I'll run this strategy on HIMS again. So for HIMS, it's one of those companies that with the lawsuit pending, I'm not in a hurry, or potential lawsuit pending, I'm not in a hurry to expand the position too quickly until we actually get a little bit of clarity about any potential lawsuit. Because if there is a lawsuit, they are definitely going to drop 10-20% within a day, and I want to have cash on hand to take advantage of that. So which is why I'm selling cash account puts for HIMS instead of just buying the shares outright. So previously, when it dropped, I did buy in the $40 range before trimming for profits around $60. I think I get that on my X post previously. But yeah, that's how I'm playing HIMS, and that's basically what I've done for the entire portfolio. So right now, jumping in, I just want to get into talking about today's company. So today is actually day 8 of covering 10 companies in 10 days. I know I've repeated this a couple of times because depending on who is here, not everybody would have caught it. And the company that we are talking about today is Affirm. This is actually one of those fintechs that have been fairly popular, at least on FinTweet. And then people, I mean, personally, when I've been investing in SOFI over the last couple of years, this was one of those companies that I actually compared SOFI with because I never understood why, especially in the last year, that they could remain unprofitable while trading at a higher multiple than SOFI. So I tend to bash them quite a bit when I talk about SOFI. I mean, not intentionally and not because I don't like the company. I do think they are a pretty good company, as you'll see later today. But yeah, I think let's start with understanding that with Affirm, I would like to say that their business model is fairly straightforward. They operate as this digital payment network that connects consumers with merchants, right? And then what they do is that they offer flexible financing option for purchases. And this is basically I think what people call it today is buy now, pay later. Now, from a personal standpoint, I am not a big fan of the concept of buy now, pay later, because I have heard people on FinTweet or even YouTube, certain creators say that if something is 0% interest, it doesn't make any sense not to take the payment plan. Now, however, for me, I have a different perspective, because I think when you are talking about if something is 0% interest, it doesn't make sense not to take the payment plan. They are optimizing that situation for having the best returns. And so the argument over there is that you are taking the money that you could be using to pay off your purchase in full, and using part of that to actually go and invest for higher returns. However, for me personally, I actually also I don't just value absolute returns. I value convenience. I value simplicity and peace of mind. And if I make a purchase and I can pay it off, I would want to pay it off in full, because I think the argument that this is money that you could be using to invest, to me, it doesn't really hold any weight, because for the way that I manage money, I do my budgeting right at the start of the month. So if I want to invest more in that particular month, like for me, knowing that September could potentially be a month where the markets are a little bit more volatile, I already make a plan for that going into 1st of September, so that when I receive my income, basically I already segregate and I already allocate more into investment for that month, and whatever I have to make purchases, it will be basically just there for purchases, and I wouldn't think about using it to invest, right? And basically, to me, I make it very objective so that I can live with a peace of mind. Because I think when you optimize for returns, I think sometimes you're what's that saying? Missing the forest for the trees? I think you have to remember the philosophy of why you are investing in the first place. People invest so that you have the financial freedom and time freedom, right? But at the end of the day, if you go to use buy now, pay later, you end up tying yourself down to these monthly payments, even at 0% interest, which goes against the philosophy of why you invest in the first place. But then beyond that, I think we are seeing people use buy now, pay later, making purchases of items $70, $80, even $100. And I want to make this discussion very nuanced here, because I am not against using debt in a smart way. I believe people can use debt to basically grow their income, to grow their net worth. And I think if you use debt on assets that appreciate over time, that makes sense. But if you're taking on debt to buy your groceries, you're taking on debt to basically finance your life, then that is where, I would classify it as bad debt. And I think that's what buy now, pay later tends to encourage. Now, I may be totally wrong here, because I think the difference in perspective around buy now, pay later might have to do with the way I'm being brought up. I think in Western cultures, people tend to be more accepting of, taking on debt and things like that. Whereas in Asia, that tends to be a lot more frowned upon. And people here tend to like to save their money. Now, overly saving and not investing is basically a whole other can of worms that I will not get into today. But to me, I think, by optimizing for returns, and then at the end of the day, you have to realize that you're still giving up something apart from just, your absolute returns. You're giving up that peace of mind, you're giving up convenience and simplicity. Because you imagine, I think when everything is good, this method of, optimizing every single dollar that you have makes perfect sense, right? You pay as little as possible for your purchases at 0% interest, especially if they have this pay in 4 payment. And then you take that money, invest it into the stock market does well, you actually make a bigger returns, and then you get to pay it off, basically free money. Now, but the truth is, you can also put the money into the market, Trump comes out, says something, and the whole market crashes. And then you're stuck with a monthly payment. Your capital that you had to pay off for your purchase is now down 30 to 40%. So therefore, even if you want to use certain option strategies to generate monthly payment, you also be in a very hard position if you understand how it works. And then you are basically stuck in the exact situation you want to get yourself out of by investing, which is basically ladled with debt, and then not being able to touch your investments because your capital is down, and then you have to go back to work, even part-time, just to make the monthly payments. So at least for me, that's why I would not, from a personal perspective, touch buy now, pay later. I only use debt for certain things. And I think in Singapore, the only thing that I can understand why people take out debt is to buy a car. Now, a car is not an appreciating asset, but in Singapore, you don't just buy the car. You need to buy the license to own the car, and the license to own the car is even more expensive than the car. So honestly, if people need a car for their families and things like that, they really have no choice, right? Because it depends on the model of car that you get. I think the cost to own a car can be the same cost that it takes to buy a small apartment. In general, like I said, yes, my principle is if it's 0% interest, objectively, if you are looking to optimize for returns, it makes sense. But I think the reason why people invest in the first place is to give yourself that time freedom and financial freedom. And it makes no sense to put yourself back into a situation where you're tied to a monthly payments just to be able to invest. And you want to invest so that you can get yourself out of these kind of shackles. So to me, that is my perspective on buy now, pay later, which is why I've never really been interested in this company. But putting that bias aside, if you look at just the fundamentals of their business, you can actually see that this is a fairly interesting business. It is a fairly strong business fundamentally. I just have a problem understanding how it's going to benefit people as much, right? So, I mean, I think, but I think that is my personal biasness when it comes to companies. You could say that, banks also do the same, which is fair. So I think at the end of the day, the fact of the matter is that in my portfolio, I already have SOFI, which are producing much higher margins than what they are doing. I already have Hood, which is, okay, I don't have Robinhood, but I do have cash set aside ready to buy Robinhood once there's a dip. And sorry? I bought Affirm earlier, but suddenly YouTube bombarded me with videos about the risk of running a buy now, pay later business. I knew there was a risk, but I got scared. I mean, I think, like I said, if you're optimizing for returns, purely returns, then sure, go ahead. I think this idea of, especially if you have a lot of cash and you already know you have that excess money to make the payments, right? By all means, use the 0% interest. I would never pay interest for any of my lifestyle choices. Okay, I only pay interest on things that appreciate with time, like my house. That's about it. But like I said, I think if I put the bias aside, pretty strong company, fundamentals improving. Why I haven't bought it, I think could be my personal bias. But at the same time, when I compare it side by side with SOFI, SOFI have better margins, a more stable business, especially through the last couple of years. And then if I'm talking about the cyclicality of their business, then I'm already eyeing Robinhood as a potential fifth position within my portfolio. And Robinhood already has a fairly cyclical business as well. So I don't want to add more cyclicality to my portfolio. And that is the bias that I have towards Affirm. And I'm trying to, and when doing this research, I had to put that aside, right? Yeah, I had to put that aside. And when I put that aside, I do see a fairly strong company on paper. And I do, oh yes, SOFI has a banking license. They are not beholden to some of their partner banks. Later on, you will see the reason for Affirm to actually fall so drastically all the way to the $8 range is because of certain operational missteps that they have done. And they actually admitted as much later on. So later on, we'll cover that. So, I mean, let's get into the business proper. Like I said, I felt like, I couldn't get into talking about this company without sharing my own perspective, but of why I didn't invest in it despite the fundamentals. And I think personally for me, I invest to get financial and time freedom, which means that I do not have any financial commitments. I do not have beyond besides my house and car. And then, yeah, I mean, I have time freedom, right? I literally now can do this basically, my research and everything the whole day, all because I have invested. So it doesn't make any sense for me to get on more debt to invest so that I can free myself from debt. It doesn't make sense to me. Let's get into this proper. Sorry. Yeah. Okay, so let's get into the business proper. Affirm's core business basically revolves around providing transparent interest-bearing and interest-free installment loans at the point of sales. And they do this both online and in the point of sale transactions in store. So, like for the benefit of those of you who are pretty new to their business, I did some digging in their 10K to give you a little bit more details about their business. To give you a little more details about the business. So we'll be looking at some metrics later on that we can use to judge how their business is growing. Now, basically, what Affirm does is that they help the consumer by increasing your purchasing power. They tell the consumer that they give you more control and flexibility, which is true. And they have a unique way of underwriting using various machine learnings, algorithms, and proprietary data that they actually from the users that puts them in a position where they can serve a large variety of customers across the credit spectrum and accurately price in the risk involved, right? So if you, on the merchant side, I think what they actually tell the merchants is that, if you use Affirm, Affirm can actually help all these merchants drive growth by enhancing demand generation and customer acquisition. So there's this one part in the 10K which I don't really understand. They say that the point of differentiation for Affirm is that they can accommodate and partner merchants to serve their payment needs across a wide variety of industry sizes, average order volume, as well as customer profile. Now, I'm not sure whether I agree that this itself is a differentiation. I'm pretty sure companies like Stripe and PayPal can also do the same thing. Affirm, Sezzle, Klarna. Will I do a stream about AMD? Oh, I mean, I have thought about it. I mean, okay, let's do this one at a time. SOFI has a banking license. That's a big difference. 100% agree. Will I do a stream about AMD, Dloco, and Tempest? Now, I would tell you, I don't have much knowledge over Tempest AI other than the fact that Nancy Pelosi bought it and then it went up. Dloco payments in Uruguay, I feel like it's a little bit of a commodity, so I didn't really look into it. I do understand why people are excited about it, and I think it could be a short to medium term. It has short to medium term tailwinds, but I think I'm not too sure about the long term tailwinds. Perhaps it could be acquired by someone. Now, with that said, I haven't looked into Dloco in a lot of details, so that's what I know from reading the headlines and certain reports. AMD, I am interested to do a longer stream on AMD and NVIDIA. I think people tend to talk about AMD and NVIDIA in a way that just compares their financial numbers. But I really want to be able to do a stream in future where I break down the technology itself and show why NVIDIA has the better tech than AMD for now, and why, despite all of that, I have still chosen to actually have a position in AMD over NVIDIA, at least for this year. But of course, after the most recent NVIDIA earnings, I'm very tempted to restart my position in NVIDIA again. Now, Sezzle and Klarna. I think Klarna is supposed to be IPOing this year, if I'm not mistaken, or at least soon, right? Which is why I think Walmart, they had this big partnership with Walmart. Walmart left Affirm and took on Klarna as their partner. I heard that it was because Klarna was about to IPO and they wanted to get more big name customers. Now, I'm not too sure. To be very honest, not too familiar with the other two names. I've heard about Sezzle, heard about Klarna. I haven't looked into their business per se, but I have looked into Affirm because when I was looking at the fintech space in the US, Affirm, Upstart, SOFI, these were names that I'm a little more familiar with. Lending Club. So I mean, Sezzle and Klarna, it's not the first time that someone has asked me about Sezzle, and not the first time someone has asked me about AMD. So perhaps sometime next week after we are done with this, I'll let you guys know basically on day 10 where this is heading, right? Where this stream is heading. All right, so back to covering Affirm. I think the main thing that we need to understand about Affirm's business, right, is that to start understanding their business, you have to look at their gross merchandise volume, right? This is how much people spend on their platform. And basically, the entire makeup of this is basically 3 loan product offerings that they have. This makes out the bulk of their GMV. They have the Pay in 4, which is the 4 bi-weekly payments of 0% APR. They also have this separate 0% APR installment interest-bearing 0% APR installment payments. And of course, the bulk of it comes from their interest-bearing loan. So if you take a look at the product mix across the past year, you can see that between 70 to around between 70 to 75%. Now, the most recent quarter, which is this graph that you are seeing over here, came in at 72%. But over the past year, it's been hovering around 70 to 75%. Of their GMV comes from interest-bearing installments, and then it's a fairly even split of around 13 to 15% between Pay in X as well as 0% APR. So what does this mean for so what this means, I guess, is that from the consumers itself, Affirm actually earns interest income on all these interest-bearing installment loans that they originate. Now, the interest on the loan does depend on various factors such as the transaction risk, the credit worthiness of the consumer, and as well as the repayment term, as well as the principal amount. So Affirm also does that because consumers are not charged any deferred or compounding interest or late fees. Hence, they're actually not incentivized to profit from consumers making mistakes or misfortunes, right? Unlike the banks. So on the merchant side, how Affirm actually makes money is that they earn a fee when they help merchants convert a sale and facilitate the transaction. This is actually fairly straightforward. The thing is that there isn't a fixed fee over here. The fees are negotiated with the merchants, and I think that depends on the products that they are offering, the amount, the average order volume, and things like that. And I think generally the guideline is that a firm earns a larger merchant fee, especially if they do offer the 0% APR product. So I think what they also do is that a firm also facilitates this virtual cards that they launch, I think in early 2021 or 2022, directly to consumers through their app. Now this card, I believe, was launched quite a while back, but only gained traction in the last couple of years, and it allows consumers to shop with the merchants that are not integrated with Affirm, right? So these merchants are charged an interchange fee for every successful transaction, and the portion of this revenue will then be, of course, they will share their cut with their issuing partners. But I think there are a couple of ways apart from what we have covered about how Affirm actually generates their revenue, things like their gain on loan sales and servicing revenue and things like that. But I'll break that down for you when we cover the valuation of Affirm, right? So this is just by and large understanding how they make money, right? They allow the consumer to pay in a certain number of time, and within a certain period, they give you 0% APR. Beyond that, you need to pay interest on whatever amount that you take out as a loan, and then they make interest on that loan. That's how they make money from the consumer, and then from the merchant side, they basically get a fee as well, right? As well as interchange fees from cards. So that's basically generally how they make money. Yes, I have a valuation for Affirm right at the end. Yes, I do. So I'll be going through how I value Affirm right at the end, and then you can see whether or not you agree. So I think for me, to understand a firm's business, apart from understanding the gross merchandise volume, we also have to look at the active customers, which is this second bar that you're seeing over here, as well as the transaction counts or active transactions per active members. So later again, these are two metrics that we will be following very closely throughout our valuation of a firm. And I have to say that, the number of members added is a lot more lumpy compared to companies like SOFI. But of course, we also have to acknowledge that SOFI has, only around 12 million members, which is about half of what Affirm has, right? So all these active members on their platform are transacting, and you can see that basically the repeat transactions from this group of active customers make up around 94% of their overall transactions every quarter. 6% of the transactions then comes in from first-time users. Now, ultimately, Affirm is a payments platform, and because of the nature of their business, when you look at the numbers, I think you will start to notice some cyclicality in their yearly revenue. But by and large, right, like I was showing you with Oscar and all that previously, the metrics are basically up and to the right, despite the cyclical nature. You're just going to see the pattern repeat, but at a higher level. And so this is, like I said, the easy way for us to track this and to know that this is on track is basically to follow the increasing revenue generated per customer. And all of these will be covered in more detail when we are looking at the valuation at the end. Right. So up to now, is there any questions before I get into the management and then why the stock has, not underperformed, but has been so volatile in the last couple of years? Right. If not, let's get into talking about the management and how they have basically the company over the last couple of years. So Affirm has really been a stock that has been volatile over the last couple of years, and I think it's important as investors to know whether or not the management is capable of taking the company through this volatile period. And I guess we need to start with understanding who is the guy in charge, which is this gentleman that you're seeing on your screen, Max Levchin. Now, everywhere I read, people tell me, "Oh, he's a great CEO." I'll be very honest and say that previously, before looking at Affirm, I think I first started looking at Affirm back in 2023. I wasn't too familiar with him. I think it's probably my own ignorance because, being from Singapore, some of his appointments, some of his companies have been more geared towards US and Europe, right? I know he founded PayPal in 1998, but if you have followed some of my PayPal videos previously, I've already said that, PayPal actually isn't that big in Singapore because we have our own payment system. Now, he was CTO at PayPal until its $1.5 billion acquisition by eBay, again, another company that is not used heavily in Singapore. And then later he founded Slide, which was acquired by Google, and HVF. And basically it's a lab that birthed Affirm in 2012. So he was on Yelp's board of directors between 2005 to 2015 and served on Yahoo's board as well between 2012 to 2015. But because, since I was old enough to actually understand what was happening around the internet, I was already using Google and I barely used Yahoo, perhaps in the early 2000s when I was back in elementary, primary school. But overall, if you ask me, he really has a pretty impressive CV. And as I take you through the last couple of years, you can actually see that I think he's very honest, he's very candid with shareholders, he's willing to admit his mistakes, and you can see that he acts very quickly on some of these mistakes to turn the company around. And that's what I really, really like about him. And so over the last couple of years, Affirm had to deal with fairly high interest rates, and it has put pressure on their buy now, pay later margin. And so in 2022, you can actually see this was this was actually extracted from their shareholder letter. You can see that the stock price went down over 60% year to date, trading in over $100 in 2021, down all the way to $50. Now, if you look at this particular paragraph in their shareholder letter, this was towards the end of 2022, you can see that Affirm basically admitted to an operational misstep with pricing. So they were late in increasing their prices while rates were rising. And the prices here are basically referring to the merchant fees and the APR that consumers are being charged for their loans. And because they were slow to adjust these numbers relative to the macro environment, so their revenue and their gross merchandise volume took a hit. Now, this was because as they raised these prices, they started to tighten their underwriting process. This basically became a increased cost to merchants, and basically that slowed down growth as well. And so to make it worse, actually in 2022, Apple also introduced their version of Apple Pay Later. Now, of course, later on, Apple discontinued that and allowed some of these platforms like Affirm to basically be on Apple Pay. But during that point of time, that was when Apple was trying out launching the Apple Pay Later. And basically this was one of those things that got people, the sentiment towards Affirm started to be a little bit more negative, and that's why people actually sold off the stock in 2022. And basically it was a slow grind all the way down from the teens to the $8 range towards the end, at the middle of the end of the year. Then when we get to the early part of 2023, where are we? Yeah. Then when we get to the early part of 2023, later on, you're going to see in one particular quarter, revenue growth actually came in at around 7.9%, just a single digit year-over-year growth. And I believe that, and you can see over here, 9th of February 2023, this is the time where they actually cut a large part of their staff, right? So basically over here, what you notice is that they cut around 19% of its workforce, and it's largely due to, basically not making the numbers during their most recent earnings call. And on top of that, you can also see that over the last couple of quarters, going into 2024, because of the rising interest rates, their average cost of funds rise, which was basically what they were alluding to earlier. But I think despite all of these things, despite all the fears around the increased funding costs, as well as that this increased funding cost acts basically as a headwinds for their revenue, they have shown signs of recovery since that early 2023 period, albeit the recovery is slightly lumpy, right, compared to what I would have liked to see. Now, basically since then, they have announced an expansion of their partnerships with companies like Walmart. not Walmart, sorry, with companies like Amazon, as well as I think at that point in time was Best Buy, right? Amazon and Best Buy. Now, at the same time, once they announced that, a couple of months later, you can see this was in April of 2024. Walmart basically launched the FinTech One, right, which basically says, sorry, Walmart-backed FinTech. They didn't launch the FinTech. Walmart-backed FinTech One launches their own buy now, pay later services. Now, this was back in April of 2024. This is not to be confused with Walmart leaving Affirm as their partner earlier on in this year. That was in 2025. But last year, right, Walmart basically reported launching their own buy now, pay later using this platform called One. But I found this story regarding Walmart quite confusing because, yes, 1 year ago, they were trying to launch their own buy now, pay later platform. But 1 year later, in early 2025, they left Affirm's ecosystem to join Klarna instead. So I'm not too sure what to read into that. Is that thing Affirm that is not as Klarna? And yeah, I'm guessing that it did this buy now pay later didn't work out for Walmart. So it also shows at the same time it's not easy to build your own buy now pay later for companies, and so that's why companies, if they want to offer this buy now pay later option, tends to have to use companies like Affirm or like Klarna. So this happened in the early part of 2024. You also had concerns over rising credit losses due to all the inflationary and recessionary fears. And I guess it is a lot of these macro news that that overshadowed some of their fundamental performance. And that was when you can see fundamentally they were starting to change to turn the business around compared to what they were doing. Now, of course, they also got a boost in September of 2024 when basically Affirm got confirmed that they were being added onto Apple Pay, right? You look at the fundamentals, like I said, beyond all these news about partnership with Amazon, Walmart leaving their platform, then them getting onto Apple Pay and things like that. I think if you just purely look at the fundamentals, they have been accelerating their GMV growth. Let me show you this. Yep, give me a second. Let me show you in the valuation file before we carry on. All right, so let me zoom in a little bit. So like I was saying earlier, sorry. So like I was saying, you can actually see, let me bring it over. So between December 2022, this was actually when they put out the announcement of them having some operational missteps. Now you can see the following quarter, March of 2023, this was when they actually grew revenue by 7%. That's when they had to cut their staff. Now the GMV at that point in time only grew by 17% year over year. Now since then, you had the announcement of going into 2024, you had the announcement of their partnership with Walmart. That happened in the end of 2023. Going into, I realized there's a labeling mistake here. Going into 2024, you had Walmart, trying to launch their own buy now, pay later. At the same time, you also have Apple announcing that Affirm is now part of, they allow Affirm to basically operate on Apple Pay. But all the while, if you look at the numbers from that 17%, you can look at the growth rates over here. They have slowly built back the company, which is why I said those things that I covered, partnership with Amazon, losing Walmart onto Apple, these are the narratives around the company. But if you look at the fundamentals of the company, they have basically tried to turn the ship around over the last couple of quarters and then eventually coming to where we are in June of 2025, right? So this is something that we have to bear in mind when we are looking at this company. There are a lot of different narratives around the company generally that basically cause the stock to be highly volatile. But if we focus on the fundamentals, over the last couple of quarters, fundamentals have been trending in the right direction. All right. So as you can see, I think if you take a look at the earnings in the most recent quarter, I think one of the things that I want to point out before talking about their earnings is that during their earnings, you're going to see this acronym called RLTC. I'm going to point it out to you later. This actually represents revenue less transaction cost. And that is the number that Affirm pays the most attention to. It's not just revenue, but revenue less the transaction cost. So we're going to see how this has performed. But if you take a look at the breakdown of their revenue over here, like I was saying, they have this merchant network revenue making up a big part of their overall revenue. This comes from all the merchant fees. And then the second one comes from their card network revenue. Like I was saying, they run their own Affirm card. So this is the total network revenue. And then on top of that, they have interest income. This comes from the consumer. And then, of course, they have gain on loan sales, basically reported over here, as well as servicing income when they actually service small parts of the loan, right? Which means that they manage the loans, including the collections as well as the customer support. And so all these make up a smaller part of other revenue, but you can see that the bulk of the revenue comes from merchant network revenue as well as the network income, where they collect interest payments on the loan offered out. So this is the most important metric to understand Affirm, which is revenue less transaction costs at RLTC. This grew 53% year over year to 353 million in Q3 of 2025. Now, Affirm has a slightly weird reporting schedule where they report their earnings. I think their fourth quarter is ends in June of every year, right? So Q4 2025 will be reported in as June, which is second quarter of 2025, right? And I think it just so happens that I didn't plan this, but their earnings are basically going to be reported end of day today, end of market day today, right? So we'll basically we'll talk about that at the start of tomorrow's stream, okay? So if you take a look over here, like I said, if you want to understand Affirm, this is the most important metric you have to understand. It's grown 53% year over year, and this revenue, less of transaction cost, as a percentage of overall GMV increased by 45 basis points to 4.1%. Now, this has slightly exceeded our long-term target range of 3 to 4, which means the revenue at less transaction cost should be around 3 to 4% of their total gross merchandise volume. But with how effective they have been in cost cutting, they have been able to drive this up to 4.1%, and we hope to see this actually continue in the quarters ahead, right? So this has really shown you the ability of management to control their costs. Like I was saying, management admitted their mistakes in 2022, and despite all the narratives, all the noise around the company, partnerships that they have formed, partnerships that they have lost, being onto Apple Pay, being threatened by Apple Pay initially, they have executed through all of that noise. They have turned the company around on a fundamental basis. And right now, what you're seeing is that they are having very strong cost controls coming into the end of 2025, because this is the first year that they actually hope to turn up profitable. And then from there on, hopefully in 2026 and onwards, they can continue to grow that profitability. So if you are looking throughout the business, or I think all the other metrics seem to really be performing very well over here. You can see gross merchandise volume is up 36% year over year. This was down sequentially from Q2 of 2025. Now, but like I said, you have to bear in mind Q2 of 2025 is actually December of 2024. And that is the holiday season where spending tends to go up. And that's why there's some cyclicality to their revenue. So revenue came in at $783 million. This was up 36% year over year. And I think the last quarter was that means Q3 of 2025. That was the first quarter that they barely became profitable. Now, I could be wrong. Later we will check. But I'm pretty sure that this was the first quarter that they become barely profitable. Just $3 million in net income. And to me, it is not just the headline numbers that look good. When you understand the company, you have to look beyond the headline numbers. And you can see their strong cost control over here. What you're noticing is that R&D, sales and marketing, as well as G&A, all of them, the yellow lines in particular, are trending down. Now, what this yellow line represents is that that is the total amount being spent as a percentage of overall revenue. And so if I break this down by each individual segment, you can see that in their R&D, their tech and data analytics segment, the cost, the absolute cost, which is represented by the blue bars, came down, and now it's re-accelerating. So they are reinvesting back into more R&D. Now, despite doing so, you can see the yellow line has still been trending down. Recently inflected upwards slightly, but I would say it's trending down perhaps even on a percentage basis compared to revenue. Sales and marketing, you can see that this has a huge drop-off, both in terms of a percentage-wise compared to revenue, as well as the absolute number. And G&A, this shows very consistent cost control, where they have more or less maintained general and administrative costs at this level in terms of cost, But you can see as revenue grows and cost remains the same, the cost as a percentage of revenue has fallen down. So this really demonstrates good operating leverage, and that is why I really like this company on a fundamental basis. But I think the large part of their business has to do with the loans that they give out. I haven't really looked too much in detail with their loans, and so I could be nitpicking because the only comparison I have in my mind is like SOFI. Like I know SOFI's numbers, and I think SOFI's numbers actually look better. Not to say these are bad numbers, but I think SOFI is slightly better. So if you take a look over here, you can see that they are tracking their various loan vintages, and they seem, which are all the colored lines, and they seem to fall within the historical range. However, if I do want to be very picky, I want to point out that the dark blue line that you are seeing, especially in the top graph, that shows Q4 of 2024, seem to be tracking slightly above earlier vintages. Now, I'm not too sure if when this actually plays out, whether or not it's going to have an effect on their profitability in future, but that is something that we need to watch out for. Now, in terms of delinquency performance in the full year of 2025, you can also see, which is the darker green line over here, it is trending above their 2020, 2022, 23, as well as 2024 rates, right? So to me, again, this is not a business where I can definitely say for sure that there is no risk even during recessions because of delinquencies. They have more or less kept it within a certain range, but they're not always getting better. Like with SOFI, you can see that every single loan vintage that they have offered since they have come onto the market have always performed better than the previous loan vintages. That is not really the case for Affirm. They tend to be a little bit more volatile in their underwriting, and that could also be down to the fact that Affirm serves a wider range of customer. So this is a risk that you have to price into the system. But I think apart from that, earlier on in the year, they have also announced an extension. I think this happened just in August, and they have extended their agreement with Shopify. Is it August? Maybe not. I think August was something else. Was like Stripe and things like that. This particular paragraph was taken from also their shareholder letter in the Q3 of 2025. Now, basically, they announced an extension of their partnership with Shopify, launched the beta of their Canadian collaboration, and announced that UK will be next, right? So they basically plan to expand outside the US. Now, on top of that, they also announced an expansion of their relationship with Adyen, which is also a payment provider. And basically, that's going to make integrating Affirm within the UK a lot quicker because Adyen is a company that is based in the UK. Now, I think what is most important for a company that charges all these merchant fees and things like that is that they tell us that their dollar-based net expansion continues to hover in the 115% range. I think ideally we want this to be at 120% and above, but renewal rates are high. 97% renewal for merchants with trailing 12 months revenue of 1 million. Oh, sorry, not revenue. With trailing 12 months GMV of $1 million or higher. So I think you can see over here that people like Affirm, and at the same time, I also think that in terms of this particular product, there's not many other choices that are doing it better than Affirm. I think comparable, yes. Perhaps companies like Klarna could be comparable. Not too sure about Sezzle. I haven't really heard about them before. At least I know Klarna because I've been to Australia a couple of times recently, so I do know that they operate from there. But I think apart from that, the people don't really have much choice, and at the same time, I think Affirm offers a pretty competitive product out there. So, like I said, recently in August, they announced a partnership with Stripe. And all of these things are just narratives that add to the business. But at the end of the day, the fundamentals of the business is what matters, right? And then as well as they expand their work with Google Pay, right? So they are now able to autofill on Chrome, which is basically, I think Affirm has been burned previously by their partnership with Peloton. I think Peloton contributed to a large part of their GMV previously, and they were really taken down by when Peloton basically went out of business. I think they went bankrupt, did they? Or at least they didn't do so. But I didn't really follow what happened to Peloton. I just know Peloton stock fell off, definitely affected Affirm because at one point they were making up a large part of their GMV. They also do not want to be put in this situation if Apple or another one of these big players come up with their own buy now pay later, like the Apple Pay Later, and then they are stuck because they are only working with one particular network. And so what you're seeing with this partnership with Stripe, expanding their partnership with Google, partnering Shopify, things like that. It's basically a way of diversifying their business. I wouldn't say that their business is 100% diversified yet, which is why later on, that's part of one of the things that we have to account for during our framework as well. So right now, I just want to take a very quick look at Affirm's valuation. But before I do that, is there any questions? Oh, wait, I believe there's one thing I need to address. Okay, tomorrow, it's going to be, not tomorrow. Okay, I said tomorrow because it's tomorrow my time, but end of day today for you guys in the US, Affirm is going to be announcing their Q4 2025 earnings. This is the outlook that they have given us. They expect revenue to come in around $815 to $845 million, with transaction costs around $430 to $445 million, right? So this RLTC should come in between $385 and $400 million, and then with 344 million shares outstanding. Now, why is this important? Because you have to remember this number later on when we are going to use their numbers for our estimation in our valuation. Okay, so you see, basically analysts in general are expecting them to bring in around 12 cents of EPS out of revenue of $837 million. So this 12 cents of EPS will help us to basically estimate their net revenue later on, and I'll do the math for you as we go through the valuation. All right, so if we take a look at Affirm's valuation over here, I just want to show you, this is basically, okay, maybe I should zoom it out. Okay, so this is basically the number of active customers on Affirm's platform. And I think what you're seeing is that the total active customers has been growing quite steadily. The number of customers added has been fair. Oh, sorry. This is not the customers added. Okay, over here, sorry. This graph, this is the one with active customers, and then you can see the net new additions over here, fairly lumpy, dropped for a while, that has increased, but then last quarter that came down again. Right, but I think the number of members that are being added onto their platform, while important, is not the key metric for them. It depends on, it doesn't matter how many members that they have, but I think it's more important that the members spend on their platform. Now, if you think about it, they only have around 20 million members on their platform with over 200 million people in the US. I would say that they still have space to expand in the US, so I'm not too worried about that. But in terms of total customer count, like I said, I plotted this against the revenue generated per customer, and you can see both has been increasing in the same direction. Now, what you're seeing over here is basically the transaction mix over here between the repeat transactions as well as first-time transactions. So you can see there is a little bit of lumpiness when it comes to the transactions, right? There's always a bump over here as you get into December. Another bump, but each time this pattern happens, it's getting higher and higher. So I wouldn't have any problems or any worry about the cyclicality, because it is a standard pattern that we can track, and you can see that it is increasing. But what is important is that you can see, the large part of this over here, which is the blue bars, this is made up of repeat customers, right? And it's only this small component over here. These are first-time transactions on their platform. And I think this basically is more or less in line with the number of customers that are being added every single quarter. Now, if you look at it on a quarterly basis, you can see one particular quarter. This was the quarter over here. If I scroll up, you can see in March of 2023. Oh, I believe this is too small, sorry. Yeah, in March of 2023. Shamil, you are not alone. I also don't own Affirm. I was mentioning earlier on about why I don't own Affirm. I think for me, I like SOFI, and I have enough cyclical names in my portfolio because I'm making space for Robinhood. Right. So you can see this was what I was talking about earlier. In this particular quarter, this was the quarter where they released around 19% of their workforce. But then since then, they have grown their revenues pretty steadily over the next couple of quarters and recovered from there. So this is represented by this dip that you see over here, and then their growth rates basically recovered from there. And I think now they're evening out in the 30% range, right? So that's very healthy. Now, operating income, you can see they were highly unprofitable for a long period of time, which is why I never understood why the market priced them at a higher price to sales compared to a company like SOFI. That is something I would never understand, but I think the market is always right. And then I think, people get humbled in the market, right? You can think that you're right, investing in fundamentally sound companies, but if the markets don't agree with you, then the markets don't agree with you. Then income, yeah, see, they finally turned profitable in the last couple of quarters, and they're expecting to do so again in the next quarter, which is basically tomorrow. Now, the free cash flow is plotted here. You can see it's fairly inconsistent. Some quarters they have free cash flow positive, like here. Some they are not. But I think you have to understand that at the same time, they have a large part of their business where it is where they're dealing with loans, they are moving loans on and off their balance sheet, and so because of that, that affects the free cash flow. And so later on, I'm not actually using a DCF to value a firm. I'll be just valuing them through the multiple approach, right? So you can see over here. Okay, no, I think I should just go straight to the valuation. This basically is a sum of all their valuation. Okay. So what you are seeing over here, I need to explain a couple of things. The first thing is that I've used $3.178 billion as an estimation for their revenue. Why? Because they tell us that revenue should come in between 3.1 to 3.3 something. So this is basically the midpoint of their guidance, which represents a 37% year-over-year growth. Okay, I think that is fairly healthy. In the hyper growth phase, as we would call it, you can see 2023, this was the year that it was quite hard for them. But I think later on, I'm not going to penalize them for that because they were growing fast beforehand and they have since managed to recover. So like I said, not going to penalize them for that. This is where I need to take you through a little bit of math to see how I get to this $24.2 million. Now, earlier on, I told you remember reading the analysts basically tell you that EPS will come in at 12 cents. Management has told us that they will have around 144 million shares. If you take 12 million, if you take 12 cents, you multiply it by 344 million, 0.12 times 344. You get around $41.2 million of net income. Now, if you take a look at their results in Q3 of 2025, you would realize that on a last 9 months, right, across the last 9 months, their net income is still negative $17 million. I believe it's 17. Yeah, around negative 17 point something. Let me take a look. I'll verify it right in front of you. So this can be checked in their 10Q. Let me see. I think it's this. Mistaken, this is the one. Okay. Am I right? I think so. Let's take a look. All right. It's this number over here. Let me zoom it in. Okay. If I take you through, what you're going to notice, net income. I don't know if you can see. Does it make sense? Okay. Net income last quarter. Net income. Oops. This is not a highlighter. Forgot. Net income last quarter came in at $2.8 million. But I just want you to I'm just going to circle this number and then I'm going to zoom it out. But even if you account for that, you can see on last 9 months, 31st March 2025, net income was negative $17.05 million, right? So this is important because if I already am holding on to a $17 million loss and I make $41 million, then basically from here, I need to minus away this $17.5 million loss that I already have, which ends up getting you to this number of $24.24 million. So that is what I expect Affirm's net revenue to net income to come in as tomorrow, right? With this number of shares outstanding, this is the EPS. Now from here, because they just turned profitable, that is why I find these kind of valuation processes very hard to do, and very hard to use as a reliable way to gauge a company's price, because you can literally use anything you want to put in any number, and you can justify whatever stock price you want. So with that being said, I'm just going to use single digit growth over the next couple of years. Three single digit margins over the next couple of years, all the way until 2028. And I think that is more than conservative enough for a company like Affirm. If you look at how SOFI are doing it, they hit profitability. Next year, profitability really ramps up. I don't think it will be 3%, but let's just assume that it is. Even if it is in 2027 at 80 times PE. Why 80 times PE? Because that is what companies like SOFI and Robinhood were trading at when they just became profitable, and the street was giving them, I think, relative to their earnings, right, is 80 times for a company that just became profitable. That's fine. By 2027, 2 years time, they should be around 99 cents of profitability. That is assuming a couple of things. That is assuming number of shares outstanding really only gets diluted by 4% over the next couple of years. In fact, that might be a little bit low, because if you look at it historically, dilution has been more than that. Now, I won't go back too far. Even if I look at the last couple of years, 4.8, 4.9, and then 11% this year, right? So it really depends on the dilution that is going to play a factor into their valuation as well. And then what is their margins over here? These are the two things that are going to be playing a factor into the valuation of the company, which to me, I feel quite hard to project out right now. Maybe because I haven't dug into every single transcript. Like when I research SOFI, I literally read through every single transcript, but I haven't done that for Affirm. I didn't have the time. It's only 3 weeks that I had to prepare. I only read through the last maybe 2 to 3 quarters. And I think perhaps with today's earnings, could perhaps have guidance from management. So with that being said, I think if we do get guidance tomorrow from management, or okay, I keep saying tomorrow because it's tomorrow my time. If we get guidance from management at the end of the day today, then perhaps we'll fit that into this model. And then at the start of tomorrow's stream, before we look at Duolingo, we will redo this valuation again. So with that, they should be worth at around 78 cents. 80 times PE, you got to bear in mind. That's relative. That's fairly high for me. Price to sales, I use 9 for the simple reason is right now that they are trading at around 10. Historically, they have traded a little bit higher, but as the revenues grow, as they become a more mature company, I'm not too sure how high this will go. I don't think it's conservative enough to use like even what they were doing at previously, around 18, 20 times, unless they really put up very, very strong growth from here. So with that, you can see using the sales, the price target should be 126 bucks. Price to earnings around $78, $79. You put this together, this turns out to be an implied price of $102.94. Now, for me, I'm giving this a 15% margin of safety. Why am I giving it a 15% margin of safety? Well, because they have made mistakes. They have made mistakes before, right? I'm not saying that companies like SOFI and all that haven't made mistakes, but I mean, their mistakes was operational mistakes. It's not image or branding kind of mistakes, but mistakes that really led to, operationally, basically resetting the company for one entire year. So, even if I don't count that, highly rate sensitive, highly sensitive to rates. Oops. Okay, if I did a mistake, highly sensitive to rates, which means that if they fail to raise their fees high enough, they're going to be basically taking it in the margins, right? They're highly sensitive to rates. What was the other thing? Oh, delinquencies higher than what I'm comfortable with. If you are comfortable with their delinquencies, this may not be a problem for you. Then you can give them a lower margin of safety. But for me, worried about that. So to me, sensitive to high rates, delinquencies higher than what I'm comfortable with. Need to see proof in a recession. I want to see in a recession really how well can their underwriting hold up, and how high can these delinquencies actually get to. Because of all these things, yes, I did say Duolingo tomorrow. Yeah. Yeah. I mean, it's a company that I like. I know people use it to learn languages. I think the AI, I mean, I'm giving you a little bit of a clue here, but I do think the AI thesis of disrupting Duolingo is a little bit far fetched. I think people that say that might just be, yeah, I think they're thinking about it from a translation point of view. They're not looking at it from a human perspective. And I think that's Duolingo's edge over there. So for me, I think I tend to have a slightly different perspective. I think AI has a lot of possibilities, but yeah, I'll speak more about that tomorrow, or maybe towards the end of the stream. Remind me. So with that, because they're highly sensitive to rates, their delinquencies are higher than what I'm comfortable with. It's always within a ballpark, but there's no consistency in how with their delinquencies. And then I need to see a proof that this actually works through a recession, not a technical recession that we had, a real recession. Not that I'm hoping that we get a recession, but I'm just saying that we need to wait until they actually get through one recession, how these underwriting and these delinquencies actually play out. Then I'll be more safe with the company. Right. I think you can say the same for SOFI. The only problem is that the only thing for me is that in a high rate environment, SOFI has shown that they can pivot. In a recession, well, SOFI serves a very high income group of people who, yesterday, if you listen to me talk about what happens in a recession, this high income group of people tend to be less affected, whereas a firm's customer base is a lot more broad based. That is what I'm pricing into this 15% margin of safety. Now, if you take it away, of course, you can say that there's a bigger upside from here. But yeah, I think that's why I am giving it a 15%. So like I said, if you do your own valuation, I'm sure you can put in numbers to make anything justified, right? You can just say, oh, next year they're going to 15, 20, 25, 30, 30. And then suddenly, wow, you have 88% upside. But I think at the end of the day, as investors, we need to be honest, intellectually honest with ourselves in how we put together the valuation, and don't just use the valuation to confirm your own biasness. So for me, personally, I feel 15% is right for me, for my risk appetite for this company and what I feel about it. And like I said, I might be biased because my biggest investment is actually SOFI. With that, I think there's only a 9.9% upside. I don't think it makes sense for me to open a position. There's too much risk priced in at this point. I could be wrong, definitely, because like I said, I've only spent a week or so studying this company. Don't know it as well as companies like SOFI and things like that. But usually, this is the level of research that I do in order to get an understanding of whether or not this is a company that I want to continue researching on in future. Now, at the end of these 10, I'm going to filter out for you which are the companies that after these 10 days, I'm not that interested in looking at. And there are a couple of companies in this 10 that after these 10 days, I'm interested in taking a deeper look and perhaps opening a position in future. All right, so let's go to the framework. Okay, this is on. Let me see. Have I copied ons? No, I haven't. Give me a second. Let me make a copy of this. Okay, and then today we are. Oops. Oh, sorry, over here. Today we are doing Affirm. Okay. Don't really have capital ratio. They're not a bank, but they do have this, right? So anyway, we'll take a look. Give me a second. Let me just take a look at their debt. I don't think they have much debt on their balance sheet. Total cash on hand 1.3 billion. All right. And then debt. Is there any debt? No long-term debt. Funding debt. No. Okay. I mean, fairly well capitalized company. Not too worried, honestly. Um. All right. Let's take a look. Okay. Before I carry on, really, Shamil's comment basically got me. I just have to scratch this itch. He says, this is actually tomorrow's video. So those of you who are interested in Duolingo, that's the company that we're covering tomorrow. I think a lot of people have said that AI is going to disrupt Duolingo because you can just ask AI to come up with a lesson that is basically interesting as well. I debate that because in order for the AI to actually be able to come up with a lesson that is interesting for a human being, the AI needs to be able to interpret human emotions and things like that. But right now, if you look at where AI is, despite how advanced it has been, I don't think ChatGPT, Gemini, or even Grok has been very good at interpreting human emotions. They're very good at problem solving, right? You can say that I argue with my wife. What should I do? They will tell you technically what to say and things like that, but they don't tell you the tonality to say it in. They don't tell you certain things to consider from an emotional, mental standpoint. And I think that is what Duolingo can do and what Duolingo can give to their audience that the AI cannot. AI can create the same app, but it cannot create that same kind of connectivity. They might not understand what the human actually likes because of the level of A/B testing that is being done by the Duolingo team. And I think the that just because AI can write another app, so Duolingo is going to be done for. I think that is a very surface level argument because that can be said for anything. Technically, I can get the AI to code an entire backend for a financial system, and then there's no need for SOFI and Galileo, right? And then you can use that argument and say that, AI is going to disrupt Galileo. So it's not that easy. You have to understand that, yes, while people can use ChatGPT and all that AI to disrupt Duolingo, it's not as if Duolingo is standing still and not using AI to actually build on their moat. So that's what I have to say for now. All right, let's get back into talking about Affirm. TAM, definitely huge. TAM growing with new verticals of disruption. I don't know whether or not they actually have new verticals for disruption. I think beyond what they have right now, they are doing global expansion. Not too sure what other new products that they can come up with. They have their main loan products, pay in 0% APR, interest-bearing loans. Fairly straightforward. Simple to explain with clear growth drivers. Yes, I mean, it's quite clear. This is not one of those businesses that is a little bit harder to explain. They basically earn an interest on the loans that they give to their customers, and then they charge merchants a fee for bringing them customers and doing the transactions. Switching costs. Is there a switching cost? Obviously, I don't think we can say that there is. We have seen Walmart left them, and Walmart brought away 5% of GMV just by losing that partnership. So I don't think we can say that there's switching costs. Network effects, definitely there is network effects. Low cost advantage. Do they have a low cost advantage? I wouldn't say so. I wouldn't say that they have any particular low cost advantage. They do have economies of scale. Regulatory framework. I would say that, yeah, in a certain way, especially if they want to get into if they want to expand their presence globally, getting into the different global markets, that would actually mean that they get regulatory approvals from the other countries. And as they do so, that actually strengthens their moats, right? Intangible asset brand. Now, this one, you guys have to tell me. I am purely basing it from this anecdotal experience of, you see, I am in Singapore and I've heard about Klarna and I haven't heard about Affirm, and I would have never heard about Affirm if I am not invested in the stock market. And that is why I wouldn't say that right now their brand in any way is that strong outside of the US. So I don't know where you would classify this. I wouldn't give it a mode. I mean, like you see, Klarna is small as well, but yet somehow or rather I know them compared to Affirm. And so I'm just saying, if I wasn't invested in the US stock market, I wouldn't have heard about Affirm. And if Affirm and Klarna appeared in front of me today, I would use Klarna over Affirm because I have heard about Klarna, right? So that's why I'm giving it 0 from now for now. Perhaps that's a little bit unfair because I would think that in the US they might be a little bit more popular, a little bit more trusted, but yeah, I don't really see it here in Singapore, so I'm using that. But I have seen Klarna, so it might be a little bit unfair to judge it that way, but that's what I feel comfortable with. If you disagree, you can give them a half a point more later on. Revenue growth faster than TAM, yes. Hyper growth definitely growing more than 2%. One dominant revenue stream with one or two smaller bets, no. So they have at least two dominant revenue streams, the transaction merchant revenue as well as interest income, right? No customer accounts for more than 10 to 15% of revenue. Yes, I would say so. I think. Merchants. Yeah, I don't think so. They don't really break it down for us. The last time this happened, that was Peloton. I think they got burnt. They learned their lesson from that. I don't think they should be here now. %. Okay, I'm not too sure about the breakdown. Let me see whether I can search this up on the spot. There's any Affirm customer. Okay, no information provided indicates that any single customer or merchant makes up more than 10% of their GMV. Okay, I think that is, I feel comfortable with that. If anyone knows otherwise, please let me know. So we give a full point. High gross margins with stable or increasing trends. Do they have high gross margins? I can't remember the gross margins. Give me a second. Gross margins for Affirm. All right, very high gross margins. Consistently in the 60. Oh wow. Okay, wait. All right. Need to. Okay. Let me share this with you. High relative, yes. To is it high relative to the business? No. I think you see what makes me a little bit hesitant to give them full marks is that it shows previously they do gross margins closer to 80%. That even I discount the 90% over here coming out from the pandemic and things like that, they were able to do 80%. That has decreased to 69, barely increased to 72. I'm not so inclined to give them full marks for this because that means they can actually do better, right? Or they have done better previously. Okay, so I think I'll be taking away some points for that. Not too much, but like I said, if you guys disagree with any of my reasoning, especially if those of you who are much more researched into this company, because this might be a core position for you, please feel free definitely to let me know and correct me down below. But I'm just talking you through my thought process because this is really how I would approach it if I was someone looking at this company for the first time, which I am. I am looking at this company in detail for the first time. Okay, so because of that, I'm going to take off 1 point for moderate gross margins relative to interest rate, not stable trends. That's why I'm taking a point off. Strong cost control, definitely, with high fixed costs. I've already shown you that 3 graphs about their R&D, their sales, as well as their marketing. That's shown high fixed cost. Debt management, okay, goodwill less than 30%. This is a little bit hard because their NPL is not really my favorite, but they don't have high debt. Again, it's not that clear. Okay, I need to really think about how I do this. Because Affirm, I think Affirm is just one of those companies that fall in between. They have a portion that is lending, they also have a portion that is not. but they are not considered a bank. But they do have interest rate risk. So you see the problem that I have over here. You have an NP, but at the same, yeah. Anyway, this is just one of those weird companies, and the categories don't really fit because I only programmed this to basically account for your CET ratio and your non-performing loans only for banks. But there are fintech that kind of issue loans as well, so fall in the crack. Now, I am going to give them 1 point here. Why? Because, like I said, not comfortable personally with their non-performing loans. I mean, they can say all they want that it has been working over the last couple of years. Fair enough. But until I see it go through a recession, or they have some ways to justify their increasing non-performing loans, then I will be satisfied. Right? Like SOFI, management has consistently come out and said that, you know what, high FICO score customer, we are not seeing any changes in spending despite all these recessionary fears. Fair enough, I can trust you. But you tell me that everything is fine, but then when I look at the numbers are increasing. That's when I get a little bit hesitant over here. All right. Net interest margin. How much are they getting? Firm earning through interest. Did they show in their? Give me a second. Let's see. There's no name, right? They just make. Okay. Yeah, they don't have a name. What am I talking about? This is weird. Okay. Because their cash flow is fairly irregular. Oh, okay. Let's just leave it. Let's take off a point for that. I think it's one of those companies that really this part of the framework, I have to admit, doesn't really, account for. I mean, Affirm just happens to be one of those companies that fall right in the cracks. But again, I said, if I'm looking at free cash flow, not impressed. But again, part of the free cash flow reasoning is because they have loans on their balance sheet. And then if I look at, they're not a bank, so they don't really have a net interest margin. I'm so sorry. Founder-led CEO, giving them full marks over here. They are not doing buybacks. Okay, some buybacks, but they're still diluting shareholders, right? So 0.5. They are using that. We have low to no risk over here. Exit unprofitable segments. I mean, they are in the midst. Is this they have no unprofitable segments, right? So they don't need to exit. Okay, that's fair. They're actively working towards diversifying suppliers and customers. I agree. Simplifying operations. I also agree. Improving liquidity. I think no risk over here. Yeah, no unnecessary. Yeah, okay. I think this is fair. Okay. I am going to deduct a point over here because business suffers in a downturn. Over the last couple of years with high interest rates, they have clearly shown this that they have suffered in a downturn. This is not one of those businesses that SOFI literally was in the same environment as them, but they managed to pivot their business, right? In this case, we haven't seen that to be true, and I think in Upstart's case, we also haven't seen that to be true as well. So I'm going to be deducting a point there, but they survived, right? Yeah. Okay, so with that, Affirm barely makes it into the story-driven category, which is more or less where I would say it is. Story-driven, I would think that if I can actually score them a little bit more accurately on their balance sheet and cash flow, they may go a little bit higher. That's what I would say. But I think at $80 today, it represents a little bit too much risk for my liking because it assumes basically strong execution all the way through into the future. But with all the job reports coming out, with a lot of uncertainty over whether or not we're getting to a recession, whether or not inflation will persist, nobody knows. And since nobody knows, I wouldn't want to be in a company that really they haven't really convinced me that they will do fine in a recession. SOFI has convinced me that they will be fine in a recession because data has proven that the high income percentile of the population will be less affected by the recession, and exiting from the recession, they will actually have a higher net worth than entering the recession. That piece of data convinces me that SOFI's model works even through a recession. Right now, we are not even in a recession. Consumers are still spending, and yet we are seeing very inconsistent underwriting results from their delinquencies and their non-performing loans. It is strong, yes. Actually, if you look at their 90 days non-performing loans, it's actually within the threshold below 2%. Somehow or rather, their 30 days is... I'm not too sure about that dynamic. Maybe I need to dig a little bit more. I do understand that I have certain gaps in my understanding of their business over here, but from what I understand, even if there are ways to plug the gaps, there are way simpler businesses out there that are easier for me to understand at this valuation. I think if you can get them if you can get Affirm at a fairer valuation, I'll be more inclined. But because they're today trading at $80 per share, if they get a good earnings, I wouldn't be surprised to see them reach $90, $100 tomorrow. It will be good for the people who are in. For those who are not in, like I said, valuation is definitely going to be a risk, because if we are pricing in possible volatility in 2026 as well as a recession, their model hasn't been tested. Now, it has been tested in a high interest rate environment and they didn't do well. So there's no certainty that recession will do well. What SOFI, like I said, has shown you is that in a high interest rate environment, they have done well. Going into a recession, we have data from the BLS that supports the income cohort that SOFI works in, that these people will not just survive through the recession, but will continue to thrive after the recession. That is why I feel a little bit more comfortable owning SOFI than Affirm. Nothing against this company, fundamentally strong. CEO has done a fantastic job in turning the company around fundamentally. I'm just not sure what... Like I said, you have to understand this is my perspective. It could be my own ignorance that is stopping me from understanding how their underwriting works for their loans. So if anybody wants to explain it, feel free to do so. But for me, I think that for a similar business, there are better options out there right now, even at this price. So with that, I think we are bringing the live stream to an end. Tomorrow, we will be talking about Duolingo. Pretty excited about that. Never started a position in it ever. I mean, I have never owned it. Don't plan to own it. The only reason why I don't plan to own it is because I have my attention in too many places right now. I want to increase my exposure to ETH after listening to Tom Lee over the last couple of podcasts. I mean, I think there are 4 podcasts in particular regarding Tom Lee and Ethereum that I think is fantastic. I think I have it saved. Let me see. Which is why I sold cash account puts on BMNR. Sorry, my nose is very twitchy today. I'm not too sure why. And it's blocked as well. Where did I save? Okay. Watch. Okay. If you are interested in understanding Tom Lee's thesis on Ethereum, listen to the Compound and Friends 6 days ago. Tom Lee was on. And then he was on Bankless around 3 weeks ago. These were the 2 podcasts that after I listened to it, I decided that, you know what? Beyond owning Ethereum itself, it makes sense to actually own BMNR. And because of that, between Ethereum, which could potentially see the whole of Wall Street move on to, and Duolingo, I mean, I apologize, but Ethereum seems like a much more exciting play and a much longer tailwind to me if it actually plays out. So yeah, I may decide to move the Lululemon cash club puts into Duolingo eventually, but for now, that's what I have. So basically, the portfolio is SOFI, HIMS, the big position as Oscar, and then calls on UNH as well as cash club puts on BMNR as well as Lulu. Oh, and then I have my Grab position, right? And then the stocks that I'm actually keeping an eye on, haven't pulled the trigger, Robinhood and C Limited. Those are companies that are always tend to be trading at a high valuation, and I think at certain point I'm just going to have to pull the trigger, because if you are buying a great company, sometimes you just have to accept that the valuation will be what it is. And so with that, I think I'll bring the stream today to a close, and then I'll see you tomorrow for Duolingo. Thanks for coming.